Yesterday, the Federal Reserve held the interest rate unchanged, but I think there's a bigger risk that's coming in months to come because of what I see in the interest rate discussion. Let's watch on and see what is this big risk. So the Federal Reserve yesterday announced that the interest rate is unchanged, but I think there is some colors within the discussion within the Federal Reserve in terms of the voting that we should be concerned about. Let's watch on, shall we? So on the surface, well, the interest rate unchanged is an expected one, and nobody really expect the interest rate to be cut, okay, or to increase. So it is not a surprise. That's why the S&P 500 more or less hovered about the same. Actually, it did break the all-time high of 7,000. But I think the bigger issue really is there's some structural shift within the Federal Reserve Committee that I think we need to be concerned about. So I think the first and foremost important thing that we need to take note is Jerome Powell, the Federal Reserve Chairman, is nearing the end of the term. So he has been reigning for 8 years, and May 2026 is coming to an end of his term. So there'll be a next Federal Reserve Chairman going to be appointed. So the Federal Reserve Open Market Committee actually came out and announced that they will hold the interest rate unchanged. So in 2025, they have cut the interest rate 3 times. This time around, they held it unchanged. And more or less, it is a wait and see approach. So basically, they are basically saying that, they need more evidence to see whether there is a need for it. And they are not bowing down to political pressure, especially from Donald Trump. The key message is they are not panicking, and certainly they are not obeying Donald Trump. The Federal Reserve has to be independent from the political pressure. If not, then something will break. Well, the Federal Reserve Chairman paused the interest rate cut is largely because right now there is no urgency to do so. The macroeconomic conditions are quite good that do not justify any more cuts in the near future. So in terms of the labor market right now, it is cooling, but it's not collapsing. So there is a slowdown in job creation, but the unemployment rate fell. So this is a textbook case of a soft landing, meaning that the aggressive interest rate hike did not lead to a massive recession of any form. It just lead to softening. And therefore, we are looking at this from a more positive point of view. So the employment risk right now do not really have the degree of change that warrant an interest rate cut. So the Federal Reserve basically removed language such as downward employment risk, right? They don't mention this phrase anymore. So basically they say we are pretty okay with the labor market. The issue is really inflation. Now, the inflation target is meant to be at 2%, but so far it seems to be an elusive target, and somehow the Federal Reserve, no matter what they do, seems to be missing that 2% target, and therefore they are going to hold the interest rate so that the inflation rate will hopefully have a glide path towards a 2%. Right now it's about 2.9, 2.7%. So we hope that, by holding the interest rate where it is, you will have a glide path towards a 2%. So I think that the balance between full employment and inflation control right now is tilting a little bit towards the inflation side. Inflation rate currently right now hovers between 2.7 to 2.8%. And very interestingly, this is where we got to give President Donald Trump some credit. There is a widespread view that tariff increase will lead to inflation, but it did not for 2 reasons. Number one-time increase in prices is not by definition an inflation. And inflation means a continual increase in prices. So therefore, one-off increase doesn't really matter. Second is actually most of the supplier ate the tariff increase and did not pass on to the consumer. So therefore, inflation did not hit that hard. probably if not because of the tariff, the inflation would probably already hit 2%. So in that sense, cannot say there is totally no effect, but the effect is not significant. So as a whole, the Federal Reserve is still concerned about inflation at this juncture a little bit more than the employment concerns. This is where it becomes interesting. Right now, in the Federal Reserve Open Market Committee, there are 12 members. Out of 12 members, 2 of them has voted that they want immediate interest rate cut of 35 basis points, which is 2.25%. 10 of them vote against. Now, this 2%, interestingly, appointed recently by Donald Trump. Not say Jerome Powell is not appointed by Donald Trump, but these 2 are recent appointment by Donald Trump. And these 2% are kind of towing the line of Donald Trump right now. Donald Trump wants interest rate cut. And these 2% are clearly showing it. So these 2 Trump-appointed board member of the Federal Reserve Open Market Committee and openly said, and one of them is a highly likely choice of Jerome Powell's successor. So if he were to succeed Jerome Powell, then it's very clear what will happen to the interest rate moving forward. And more importantly, this man really told the line of what Donald Trump wants. So the question right now is the independence of the Federal Reserve Board. So this is where Jerome Powell right now is facing a lot of pressure, and he's holding the independence of the FOMC, the Federal Reserve, as sacred as possible. He's also being charged, okay, for potential mismanagement of some construction funds of the Federal Reserve renovation. And this is clearly a political attack by Donald Trump. So, he's facing a lot of pressure, but he's holding on to the line and basically say that I will do my job all the way till May 2026. So the market reaction seems to be very calm towards the whole thing. Now, clearly, a lot of people are looking at the current interest rate right now as okay. It's holding on, not good news, not bad news. So the market actually stabilized. Initially, it went up a little bit to cross 7,000 points, but it kind of stabilized where it is, signaling that it is a combination of two things. Number one is they are clearly not happy that there's no interest rate cut, although it's already factored in. But they also saw that the 2% that are against the rest of the decision by the 10 members are the other people. They are most likely going to succeed Jerome Powell. So moving forward, the likelihood of an interest rate cut, probably in an aggressive way, is going to be high. So this is a blended results. So right now, the S&P 500 actually hit past 7,000 points, and had it come earlier before the 31st of December, I would have won Benjamin, my son, a bet, but I missed it by 28 days. It's okay. I'm 1 month late, but it did cross 7,000 points, which is a good news. Then after that, it came down, softening a little bit. So once you breach that level, you'll continue to go up higher and higher post that. That's just how stock market works. So I think this is good news from a trajectory perspective. Now, interestingly, right now, with this decision of not cutting interest rate and not cutting interest rate for the near future, the USD is not going to crash much further because it needs to hold on. It needs to hold. The interest rate holding on will help the USD to hold on at where it is. And as a result, the ringgit is unlikely to strengthen a lot more. Unless there is a Japanese yen crisis again, I think the outlook of a US dollar crash is unlikely in the near term. I think the bigger issue that everybody needs to be more concerned with is how will the market judge the next Federal Reserve chairman being a person that will toe the line of Donald Trump. Some people use the word stooge, okay? But basically, the next Federal Reserve chairman clearly will obey Donald Trump. That basically vaporized the independence of the Federal Reserve. And as a result, central bank losing its independence is a big issue in most countries. So therefore, it will have implications throughout. Maybe because of this, the stock market will have a crash, at least to test whether the Federal Reserve will remain its independence. So when we say a test, maybe they could trigger a crash of some form. I give you an example. In Indonesia, there's a real case study right now. Just a day or two ago, a combination of reasons, but one of them was the president nephew was appointed the deputy governor of Bank Indonesia, which is the central bank. As a result, the market view that this is not independence, and they trigger a 7% market crash. Of course, there are some other factors that led to that crash as well, but this is one of them. So markets don't like central banks to be independent from the government, and this is clearly an issue. So as a result, what does this mean for rest of us? I think we should watch and see so that we know when some crisis were to hit, we know the cause of it. I don't think that the stock market will have any big movement because of this factor until May. And we shall see whether the market really will test the new Federal Reserve chairman for his independence. So if the market were to view the appointment of the Federal Reserve chairman very negatively, then we're going to have an issue with the stock market. How far will the stock market go to test this? I don't know. But certainly this will be viewed very negatively. So let's just watch on and see how it goes. In the meantime, I think there should be some stability in the foreign exchange market. I think there'll be some stability in terms of interest rate movement and bonds as well. Let's see and hope that things kind of remain flattish as where it is. We shall see, and I'll see you guys in the live stream. Bye-bye.